Nigeria's pension industry maintained its steady performance in July 2025, delivering positive return across all retirement saving account RSA fund categories, despite macroeconomic headwinds and tighter financial conditions. According to data, all 18 pension fund administrators PFA recorded gains, with FCMB Pension Limited emerging as the top performance, posting a monthly average return of 5.68%, driven by strong return across all RSA fund types. Welcome to Business Point, where we x-ray the Nigerian economy and the government's policies. I am Kike Lomo Okere. The pension system average fund growth stood at 4.20% for the month, reinforcing investors' confidence in the resilience and stability of Nigeria's contributory pension scheme. The month of July witnessed significant gain across the 4 RSA categories, with RSA Fund 1, the higher risk and high return category, which delivered the highest average return of 6.30%, driven by higher exposure to variable income instruments. RSA Fund 2, the default fund for active contributors under 50 years, posted a 5.33% on average return. RSA Fund 3 targeted a pre-retiree 50-plus returned 2.06% gain, while RSA Fund 4, the most conservative fund for retirees, returned 1.47%, in line with its low-risk investment structure. Top performing PFA in July 2025 based on average percentage change across all RSA fund categories. The following pension fund administrator emerged as the best performer in July 2025. FCMB Pension Limited dominated the chart with an average monthly return of 5.68% and standout performance of 7.29% in RSA Fund 2 and 4.23% in RSA 2. Pension Alliance Limited having an average return of 5.62%, with a strong and consistent performer across all funds, notably 8.89% in RSA Fund 1 and 7.28% in RSA Fund 2. Trust Fund Pension PLC, with an average return of 5.48%, posted a remarkable 9.37% gain in RSA Fund 1, the highest return among all PFAs in any fund category. RSA Fund 2, tailored for contributors under 50 with a medium risk appetite, posted an average return of 5.33% in July 2025, reflecting steady performance across the category. As of June 2025, Nigeria's total pension fund assets stood at 24.63 trillion naira, according to the National Pension Commission. That is 2.17% increase from 24.11 trillion naira in May 2025. A breakdown of the portfolio shows that the federal government of Nigerian security remains the dominant asset class, accounting for 61.65% of total assets, amounting to 15.19 trillion naira. Corporate debt, security, and money market instruments represent 9.19% and 9.08% respectively, while investment in domestic equity rose to 3.08 trillion naira, that is 12.51% of total assets, while mutual fund contributed 0.75%, totaling 183.82 billion naira. RSA registration and fund distribution, that is the total RSA registration, reached 10.79 million as of June 2025, reflecting a 4.01% year-on-year growth. The default fund for active contributors RSA Fund 2 remains the largest by NAV with 10.29 trillion naira, accounting for 41.81% of total assets. RSA Fund 3, designed for contributors aged 50 and above, expanded to 6.39 trillion naira, while RSA Fund 4, catering exclusively to retirees, recorded a moderate 2.14% month-on-month growth, reaching 1.83 trillion naira. Foreign investors sold off equity worth 576.09 billion naira on the Nigerian exchange between January and June 2025, representing a 84.97% increase from 311.41 billion naira withdrawn in the same period of 2024. The outflow exceeded foreign inflow, stood at 559.25 billion naira, resulting in a net negative foreign portfolio position of 16.84 billion naira over the 6 months. The figures contained in the NGX June 2025 domestic and foreign portfolio investment report shows that the foreign trading activities has intensified compared to the same period last year. Total foreign transaction reached 1.14 trillion naira in the first half of 2025, more than double the 540.48 billion naira recorded in first half of 2024. As economists attributed the surge in outflow to the inconsistent cost in global markets by policies of U.S. President Donald Trump. The high yield in Treasury bill and spur sell-off, among others. Meanwhile, domestic investors accounted for 3.06 trillion naira worth of trade between January and June 2025, representing 72.92% of total market transaction. This marks a 41.5% increase from 2.17 trillion naira in the same period of 2024. Of the total domestic figure, institutional investment contributed 1.59 trillion naira, while retail investors traded at 1.47 trillion naira. The near parity between retail and institutional activities suggests balanced domestic participation over the half year, though recent months shows institutions gaining dominance. Although the total value of transaction on exchange during the 6-month period amounted to 4.19 trillion naira, up to 60.98% from 2.60 trillion naira recorded in the first half of 2024. This rise, though positive in volume, marks growing concern over the quality of capital flow, particularly the surge in foreign outflow and declining retail activity. A breakdown of monthly data reveals volatile investors' behavior, with large fluctuation in both foreign and domestic trade. In January 2025, total transactions stood at 346.23 billion naira, split between 269.39 billion naira domestic and 76.84 billion naira foreign. Retail and institutional domestic trade were almost evenly split at 134.17 billion naira and 135.22 billion naira respectively. By February, activities climbed to 448.52 billion naira. Foreign inflow were at 43.67 billion naira and outflow were 47.93 billion naira, reflecting modest negative inflow. Retail participation dropped to 123.38 billion naira, while institutional trade rose to 170.54 billion naira, indicating a gradual institutional build-up. March marked the highest activities point in the first half of 2025. Total transactions surged to 1.29 trillion naira, driven by unusual spike in foreign inflow to 349.97 billion naira, more than the combined total of all other months. Outflow stood at 205.54 billion naira, leaving a net gain of 144.43 billion naira. Institutional domestic investors increased their exposure to 273.74 billion naira, while retail trade reached 212.77 billion naira. However, April reserved this momentum. Total trade fell sharply to 487.39 billion naira. Foreign inflow dropped to 26.47 billion naira, while outflow rose to 70.20 billion naira. Retail trade fell to 174.10 billion naira, while institutional investors slowed to 180.62 billion naira. The reversal collided with the announcement of a 14% tariff of Nigeria by U.S. President Donald Trump. In May, foreign outflow remained elevated at 60.94 billion naira, while inflow were subdued at 24.12 billion naira. Institutional investors traded at 244.13 billion naira, up from April figure, while retail investors increased marginally to 337.46 billion naira. Total trade in May stood at 700.50 billion naira. June data shows another month of high trading activities. Total traded amounts to 778.65 billion naira, the second highest after March. Foreign inflow recorded to 72.82 billion naira, while outflow moderated slightly to 66.49 billion naira. The month ended with a net positive foreign position of 6.33 billion naira. On domestic side, institutional investors accounted for 364.7 billion naira, rising to 49.39% from May, while retail trade fell at 18.62% to 274.63 billion naira. The foreign investment pattern over the 6 months indicates an underlying sensitive to foreign exchange liquidity and policy clarity. The naira depreciation to 1,529 naira to a dollar at NAFEM in June, from 1,558 naira to a dollar in May, which supported a modest recovery in inflow. However, the continued dominance of outflow reflects lingering concern over FX repatriation and macroeconomic policy stability. It is observed that institutional investors have gradually widened their lead over retail participants in recent months, while both groups were nearly even in January and February. Institutional trade began to outpace retail trade from March onward. The gap between more visible in June, with institutional trade at 364.7 billion naira compared to retail 274.63 billion naira. Retail participation peaked in May at 337.43 trillion naira before declining in June. This may be due to inflationary pressure, which continue to erode real wages and reduce the disposable income available for investment. With inflation hovering above 22%, more households are spending more on necessity rather than saving or investing. The strengthening of institutional activities on other ends reflect portfolio rebalancing by pension fund and asset managers seeking higher returns amid rising inflation and tepid fixed income yield. Despite the 61% year-on-year increase in market turnover, the investors' mix raises important questions about the sustainability of market growth. Foreign investors remain active but cautious, as evidenced by the consistent outflow. Meanwhile, the gradual dominance of institutional investors points to a concentration of market liquidity within a narrow group of players. Retail investors, who are crucial for market depth and resilience, appear to be stepping back to economic strain. In a bid to curb the higher import of raw materials and other manufacturing inputs into Nigeria, the federal government is set to introduce tax incentive for Nigerian manufacturers that use locally sourced materials. Disclosing this at the 2025 Nigerian Manufacturing and Equipment and Nigerian Raw Material Expo in Lagos, Minister of Information, Science and Technology Uche Nnaji says the government has approved the plan to grant Raw Materials Research and Development Council the authority to implement significant tax incentive designed to reward manufacturers and innovators using locally sourced inputs in their production processes. Under the proposed incentive, the compliant firm in agro-processing, pharmaceutical, polymer, fabric, green tech, among others, will get tax credits, duty relief, investment allowance, and exercise waivers. Meanwhile, Director General, Raw Material Research and Development Council, Professor Martin Ike Munoso, has emphasized the need for Nigeria to decisively reposition itself with the dynamic of the fourth industrial revolution, noting that the over-reliance of the Nigerian manufacturers on imported inputs signifies a structural weakness in the economy. Ike Munoso stated that over 70% of manufacturing inputs used in the economy are imported, according to figure released earlier this year. These data points expose a structural weakness, meaning that raw materials are export in crude form, import in the refined quality, and surrender job and value of offshore before it started. It says the country possesses over 120 commercially viable solid mineral, vast agricultural resources, and demographic dividend in the young population. It says there is need for strategic coordination, bold implementation, and technology-backed commitment. President of Manufacturer Association of Nigeria, Francis Meshoye, says embracing cutting-edge technology solution, manufacturers are accelerating innovation, resilience, and long-term value for their stakeholders. Speaking on the aim of the expo, Meshoye stated that the focus is to spark conversation around the deployment of energy efficiency in production processes, implementation of smart factory protocols, including Internet of Things, and artificial intelligence to optimize resources use, adopt waste reduction strategies through closed-loop system, and advance recycling methods. Nigerian Telecom Regulators has introduced a new governance framework for operators as the country telecom sector recorded a sharp decline in foreign direct investment in the first quarter of 2025. The rule unveiled by the Nigerian Communication Commission seeks to strengthen broad oversight, risk management, and transparency across Nigeria's $70 billion telecommunication industry, which serves more than 170 million active subscribers. The guidelines will be enforced in phases and apply to all licensed operators. The rollout comes as the telecom industry reported $80.78 million in foreign direct investment in the first quarter of 2025, down to 58% from $191.57 million in the same period a year earlier. According to data from the National Bureau of Statistics, quarter-on-quarter foreign direct investment also dropped 41% from $136.86 million in the fourth quarter of 2024, while the NCC made no connection between the introduction of the rules and the decline in capital inflow. The timing highlights the need for stronger governance practice in Nigerian digital infrastructure landscape. The 2025 guideline builds on earlier version issued in 2014 and 2016, which were earlier voluntary, that is lightly enforced. However, the chief regulator says it recognized that stronger sector-specific rules were necessary to match the growing complexity of the Nigeria digital ecosystem. Let's take a quick short break. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, this is Business Point, where we extract the Nigerian economy and the government policies. The Nigerian Upstream Petroleum Regulatory Commission says the 220 open oil blocks scattered in various onshore and offshore basins across country will be handed over to concessionaries after the periodic bid rounds and conditions are met. The NUPRC data shows that deep offshore terrain accounts for the highest number of unlicensed blocks at 59, highlighting the country's underexploited energy wealth in its most technical, advanced, but capital-intensive region. The Benue Trough follows with 41 open blocks, while the Chad Basin hosts 40. In Sokoto Basin, there are 28 blocks yet to be awarded, and in Bida Basin are 16. It was also disclosed that even in more mature area, idle blocks persist. The offshore Niger Delta, often considered the backbone of Nigeria's oil production history, still holds 7 open blocks. The Anambra Basin has 13 open blocks, while 8 each remain unlicensed in Benin Basin and the onshore Niger Delta. In a statement, the NUPRC says the unlicensed 220 oil blocks were not abandoned, but awaiting concessions in line with the Section 7 of the Petroleum Industry Act 2021, which empowers it to conduct periodic licenses rounds and award oil blocks to successful bidders. The Commission says the open block 59 of which are in the offshore deep waters will be handed over to investors after a round bid. Recall that the Commission in December 2024 announced a licensing bid round for 2025, but that has yet to commence. The Commission clarified that 220 oil blocks were not abandoned, but were simply awaiting concession in line with Section 7 of the Petroleum Act 2021, which empowers the Commission to conduct periodic licensing around and ground petroleum prospecting license and petroleum mining leasing to prospective investors. The Commission further stated that the 220 oil blocks will be handed to concessionaires after periodic bid. All right, this is where we draw the curtain on Business Point today. Join me again tomorrow on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms at Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.